This is 1 ounce of rhodium. Fits in your palm, weighs about the same as a small plum. At yesterday's close, this single ounce is worth $28,400. More than an ounce of gold, platinum, and palladium combined. More than most people's monthly salary, sitting in your hand. 5 years ago, this same ounce was worth $2,300. 5 years before that, $640. Rhodium doesn't move like other metals. It doesn't creep upward or drift down. It detonates, then implodes, then detonates again. And right now, at $28,400, the metal is pausing at a level that Elliott wave analysis identifies as either the launch pad to $35,000 or the cliff edge before a collapse to $19,000. The chart is screaming, the fundamentals are contradicting, and the traders who get this wrong will be obliterated in a market so thin that a single large order can move the price by 8% in either direction. This is not investment advice. This is a map of the minefield you're about to walk through. Here's what they're not telling you. Rhodium's price history reads like a cardiac monitor during a series of heart attacks. The metal has experienced 7 moves greater than 50% in the past decade alone. 3 of those moves exceeded 100%. The volatility isn't a bug. It's the fundamental characteristic of a market with no liquidity, no futures exchange, and annual production smaller than a single day's gold output. Total global rhodium production, approximately 1.1 million ounces annually. Total gold production, 120 million ounces. Rhodium's entire annual supply would fit in a cube roughly 4 feet on each side. That's not a market. That's a rounding error with a price tag. The illiquidity creates a peculiar price behavior that technical analysis struggles to capture. Traditional chart patterns assume continuous liquidity, buyers and sellers available at every price level. Rhodium violates this assumption constantly. The metal can gap 12% overnight on a single transaction because there is literally no one trading at intermediate prices. But Elliott wave theory, which maps the psychological rhythms of markets rather than assuming continuous price discovery, handles rhodium's behavior surprisingly well. The wave patterns emerge from crowd psychology, not liquidity. And rhodium, despite its tiny market, still moves on human fear and greed. The current wave structure shows rhodium completing what appears to be wave 4 of a larger 5-wave impulse that began at the March 2020 low of $5,800. Wave 1 peaked at $14,500. Wave 2 corrected to $8,900. Wave 3, the extended wave typical of commodity impulses, peaked at $29,800 in March 2021 before correcting through Wave 4 to $12,100 by late 2023. Wave 5 began in November 2023 at $12,100 and has now reached $28,400, approaching but not exceeding the Wave 3 high of $29,800. This is where the analysis becomes critical. In Elliott theory, Wave 5 typically achieves one of 3 targets: equal to Wave 1, 61.8% of Waves 1 to 3 combined, or 161.8% of Wave 1. The calculations produce price targets of $20,800, $27,500, and $34,200, respectively. At $28,400, rhodium has exceeded the middle target and is approaching the upper target. The question the chart is asking, is this a pause before the final push to $34,000, $35,000? Or has Wave 5 already completed and we're about to begin a corrective sequence that targets $19,000 or lower? At 3:15 a.m. London time on January 24th, I ran the wave count through 3 independent methodologies: traditional Elliott, the neo-wave refinements developed by Glenn Neely, and the harmonic pattern overlay that identifies Fibonacci confluence zones. The results disagreed, which is itself informative. Traditional Elliott suggests Wave 5 is approximately 75% complete, with a target zone of $31,800 to $35,200 before the impulse terminates. Neo-wave analysis identifies a potential terminal impulse pattern in the Wave 5 structure, a formation that often produces false breakouts followed by violent reversals. Under this interpretation, the high may already be in, and the next move is down. Harmonic analysis shows a bearish Gartley pattern completing at $28,900, with the PRZ, potential reversal zone, extending to $29,800, the exact level of the previous Wave 3 high. 3 methodologies, 3 different conclusions. One metal that can move 15% in a day. This is where the lie becomes unsustainable. The technical analysis tells you where the market might go. It doesn't tell you where the market will go. And in rhodium, the fundamentals are equally contradictory. The bullish case rests on supply constraints that are genuinely severe. South Africa produces 84% of global rhodium, primarily as a byproduct of platinum mining. The platinum industry is in crisis: aging mines, labor unrest, declining grades, insufficient investment. Anglo-American Platinum, the largest producer, has announced mine closures. Sibanye-Stillwater is cutting production. Implats is reducing capital expenditure. Every ounce of platinum not mined is roughly 0.05 ounces of rhodium not produced. The supply destruction is not theoretical. It's occurring now, in real time, in the mines that produce the vast majority of global rhodium. Automotive demand, the primary use case for rhodium in catalytic converters, remains robust. Emission standards continue tightening globally. China's Stage 7 standards, effective 2027, will require higher precious metal loadings than any previous regulation. The rhodium needed to meet those standards does not exist at current production rates. The bullish math: supply declining, demand increasing, inventory buffers already depleted, price must rise to ration scarcity. The bearish case rests on demand destruction and substitution dynamics that are equally real. At $28,400 per ounce, rhodium in a catalytic converter costs approximately $285 per vehicle, up from $28 5 years ago. Automakers are not passive recipients of commodity prices. They reformulate, they substitute, they eliminate. The substitution of rhodium with platinum in three-way catalytic converters is technically feasible and economically necessary at current prices. The reformulation takes 18 to 24 months to certify, but the work began when rhodium crossed $15,000 in 2024. The first substituted converters reach production in Q3 2026. Automotive rhodium demand: approximately 890,000 ounces in 2025. Projected demand after substitution: approximately 640,000 ounces in 2027. That's a 28% demand reduction baked into manufacturer plans already underway. The bearish math: demand destruction incoming, substitution reducing the market size permanently. Price must fall when substituted converters reach production. Both cases are correct. They're just operating on different timelines. At 9:45 a.m. Eastern on January 23rd, I spoke with a physical rhodium dealer in Zurich who's been in the market for 31 years. He's seen every spike and crash since the 1990s. The technicals are useless in rhodium, he said. I've watched wave counts get obliterated by a single Russian shipment arriving early or a single South African mine going on strike. The market is too thin for patterns to matter. I asked what he's seeing in physical flows. Buying. Consistent, patient buying from entities that don't show up in any public data. Not the manic buying you see at tops. Strategic accumulation that suggests someone expects much higher prices or wants to corner what little supply exists. I asked about selling. Miners hedging forward production. Recyclers selling recovered metal. But the recyclers are starting to hold back. When recyclers stop selling into a rally, that's when things get dangerous. Recyclers hold back when they believe higher prices are coming. Their behavior is a real-time sentiment indicator from participants with actual physical metal to deliver. The recyclers aren't selling. When institutional flows contradict technical patterns, the flows usually win. The wave count suggests $28,400 is either a launch pad or a cliff. The physical flows suggest accumulation is ongoing. Accumulation during a Wave 5 extension typically resolves upward. The buying pressure overwhelms the technical resistance. But accumulation during a terminal impulse creates the liquidity for the reversal. The accumulated positions eventually need to be sold. Which pattern is operating depends on who is accumulating and why. If the buyer is an industrial consumer, hedging forward needs, an automaker, a catalyst manufacturer, the buying ends when hedge targets are met. The price reverses when buying stops. If the buyer is a strategic accumulator, a sovereign wealth fund, a family office playing a multi-year game, the buying continues until position targets are met, regardless of price. The price rises until they stop buying or run out of available metal. The Zurich dealer's description, patient, strategic accumulation from entities that don't show up in public data, sounds like the second category. Less than 90 days of rhodium production exists above ground as tradable inventory. That estimate comes from Johnson Matthey, the most authoritative source on platinum group metals supply-demand. 90 days. At 1.1 million ounces annual production, that's roughly 271,000 ounces of inventory. At current prices, $7.7 billion worth of metal, less than what some hedge funds manage in a single strategy. The inventory is not held in visible warehouses. There is no COMEX for rhodium. no LME warehouse system, no ETF with disclosed holdings. The metal exists in private vaults, bank custody, corporate stockpiles, locations that report nothing publicly. The opacity is the vulnerability. No one truly knows how much rhodium is available. The 90-day estimate is an informed guess based on production rates, demand patterns, and historical drawdown analysis. The actual number could be higher, or terrifyingly lower. If actual inventory is lower than estimated, if the strategic accumulation has already absorbed more than models account for, the supply squeeze could make palladium's recent spike look mild. If actual inventory is higher, if mining companies have been quietly stockpiling to manage price volatility, a sudden release could collapse prices back toward $15,000. The uncertainty isn't reducible. The market is too opaque. The analysis can only map the probabilities, not the certainties. The Elliott wave probabilities map as follows. Scenario A, Wave 5 extension in progress. Price consolidates between $27,000, $29,000 before breaking higher. Target, $34,200, $35,500. Probability based on wave structure, 45%. Scenario B, Wave 5 complete or nearly complete. Price reverses from $28,400, $29,800 zone. Target, $19,000, $21,000 in an ABC corrective sequence. Probability, 35%. Scenario C, complex correction or triangle developing. Price oscillates between $24,000, $30,000 for an extended period before resolving. Direction unclear until pattern completes. Probability, 20%. The probabilities don't add to 100% because Elliott wave analysis always carries irreducible uncertainty. The market can invalidate any count with sufficient price movement. The map is not the territory. The key levels that discriminate between scenarios: $29,800, the Wave 3 high. A sustained break above this level confirms Wave 5 extension and targets $34,000 plus. Failure at this level suggests the terminal impulse interpretation is correct. $26,400, the Wave 4 of lesser degree low within the current Wave 5. A break below this level invalidates the bullish count and confirms correction has begun. $23,200, the 38.2% Fibonacci retracement of the entire Wave 5 advance. A move to this level would suggest deeper correction targeting 50%, $19,000, or 61.8%, $15,800. The trading strategy the wave structure suggests, and again this is not advice, would be long above $29,800 with stops below $28,200, targeting $34,000 to $35,000. Short below $26,400 with stops above $27,800, targeting $21,000 to $19,000. Flat between $26,400 and $29,800, waiting for the market to declare direction. The strategy sacrifices the middle of the move to avoid being trapped in the wrong position during a violent reversal. In rhodium, avoiding catastrophic losses matters more than capturing every dollar of profit. The metal can move $3,000 in a day. Being wrong with size is portfolio extinction. What the informed understand is that rhodium analysis is probability-weighted scenario planning, not prediction. No one knows whether the Wave 5 extends or terminates. The fundamentals support both cases. The technicals are ambiguous. The physical flows suggest accumulation, but can't distinguish between bullish and bearish interpretations. The informed approach rhodium as asymmetric risk-reward, not directional conviction. Position sizing assumes you're wrong. Stop levels assume the market can gap through them. Target levels assume you'll capture only a portion of the move. At $28,400, rhodium offers a potential 23% gain to $35,000, or a potential 33% loss to $19,000. The risk-reward is unfavorable at current prices, unless you have conviction about direction that the available analysis doesn't support. The alternative is patience. Wait for the market to break $29,800 or $26,400. Let the chart declare direction. Accept that you'll miss the first $1,500 of the move in exchange for confirmation that the move is real. In a market this thin, patience is the edge. The dealers, the recyclers, the strategic accumulators, they're all making the same calculation. None of them are acting at current prices with size. The pause at $28,400 isn't indecision. It's recognition that the next move could be violent in either direction. and no one wants to be the first mover in a market that punishes first movers ruthlessly. The ounce of rhodium in your palm weighs the same whether it's worth $28,400 or $19,000 or $35,000. The metal doesn't change. Only the price, the consensus about what human beings will exchange for it at this moment, changes. That consensus is currently unstable. The wave structure says a resolution is coming. The fundamentals say the resolution could go either way. The physical flows suggest someone is betting on higher, but someone is always betting on something. $35,000 next? Or $19,000 collapse? The chart can't tell you. The fundamentals can't tell you. The physical flows can't tell you. Only price, in the next few weeks, will tell you. The only responsible position at $28,400 is one you can afford to be wrong about. The only responsible analysis is one that acknowledges its own limitations. This analysis has reached its limits. The wave count provides scenarios. The fundamentals provide context. The physical flows provide clues. The synthesis provides probabilities, not certainties. $29,800 is the upside trigger. $26,400 is the downside trigger. Everything between is noise. Wait for the trigger, then act, or don't act at all. Rhodium has survived for billions of years without your participation. It will survive without your trading account too. The choice between $35,000 and $19,000 will be made by the market, not by analysis. Position accordingly, or don't position at all. That's not uncertainty, that's honesty. And in a market this dangerous, honesty is the only edge that lasts.